Good morning to everybody. I can notice how maybe we talk about currencies and you have that in the menu and you might say, oh, this is for my finance people. And this is true. If you're from your finance department or you have relationship in your teams, please stay. But this is especially relevant if you are not from the finance team. Because what I will try to cover and unleash today is the impact your finance teams are having in your business when talking about currencies. This is a very, very relevant topic when you're building your prices, but also on your purchasing machines. And hopefully, during the presentation of today, I should be able to cover how this has an impact in your different businesses, either if you're a hotel, or a DMC, or a bed bank, or a tour operator, or a travel agent, and also make sure how you can benefit the most out of it. All right? We will also, by the way, cover a success case of a client of ours, is the WebBets Group, and we'll see how they have been benefiting from using the currencies in a smart way. So if I know how to point and pass the slides, would be excellent. Hello? Technology is struggling. I don't know if you can just push past the slides. Yeah, there you go. Thank you. So again, these currencies is something that it's typically seen as a problem. In the companies, you say, the finance team especially, try to stay away from the use of it, and we all try to say, well, let's deal with euros, dollars, and pounds, because this is what we're comfortable with. But this has very significant impacts on the value chain of travel. We see it on the contracting direction, but also on the selling direction. I always say that currencies are like languages. Hopefully, I mean, if you have here someone from marketing, it will probably tell us that it's not very smart to do advertising in Spanish in the UK, right? This sounds quite obvious, but I see every single day how apparently it's very normal to sell in euros in the UK, because our finance people don't want to take the risk of managing euros against pounds or pounds against euros. So this is also, and this is what we're going to see, carrying consequences on our competitiveness and on our attractiveness to the customer. Either if we are an agency and we are talking into a B2C world, or we are an online OTA which is selling online, if we really try to capture the market in Switzerland and we are not selling in Swiss francs, we are passing the cost of conversion. And you've probably all experienced how going with your credit card in your own currency and paying in another currency, the price has little or nothing to do compared to the price you checked on the internet. How much is this going to cost me? And then you pay with the card and suddenly you're charged 5 or 10% more. This is exactly the same in businesses. Maybe not 5%, but at least the 2% easily. And this basically alienates the customer. Even on the B2B, we see how some of companies do not make available part of the product if they are not able to sell it in a certain currency. Because they say, if I sell in pounds, I buy in pounds. Whatever I cannot buy in pounds, I don't buy it. This is limiting your business, clearly. Let's see an example of this. Let's see an example on the contracting side. We are an online travel operator, and we are sending people to the US. And we have different suppliers that offer us this hotel. One of them is offering it to us in US dollars, and two others in euros. I guess the comparison to make between the two offers in euros is quite simple. No? If we have an 85 and a 90 euros offer, we are probably going to go for the same hotel and the same date for the 85 euros offer. But then what happens with the 85 and $100? Well, here's where the interesting dynamics are being created. If we are selling in euros, I'm tired to see how many companies, again, bed banks, agencies, DMCs, are going to choose. I'm going to say, if I am selling in euros, I am buying in euros. I'm going to select my euro price, I'm going to mark it up and sell it. But if we actually have a deeper look at this, we even can have, and we make a comparison. Let's take, for example, a 124 rate. This $100 is actually 80 euros, right? Which can make a lot more sense to buy. It's a much more profitable sales. We're going to be more competitive. Our inventory will be much more competitive to our end customers, or we will simply do more margin. But the reality is that this 124 is not the rate that is used. Why? Because your finance teams are saying, well, because I have a currency risk, because I have the booking today, and I'm only going to pay it in 3, 6, 9 months, I have to protect myself from this. I have a risk. So instead of using a 124, I'm going to use a 120, which is a markup that I'm using. So the real cost of these 80 euros turns out that in your system is reflected as an 83 euro cost. And then you are selling it in pounds, imagine it. And one would say, well, we would need to take the spot rate of the pounds, right? And then you create the pound. You are going out with a 73 pound price. Well, you can see the lack of competitiveness in a business that is so strong. But it not only starts here. If we go also to the selling side, this actually can mean that my finance team is also saying, well, because you're selling in pounds, because I'm going to collect it in the future, you cannot use exactly today's rate. I will give you a rate that is inflated. And you end up putting a 7% over cost that is, it's fake. It's an artificial cost. It's just an insurance to your teams. And don't get me wrong, this insurance makes the whole sense. It makes a lot of sense. Your companies have a lot of risk managing currency. But the difference is that this cost is being included just to protect themselves and hope that in the future, the rate will not have moved more than 7%. But it's dragging our competitivity down, down, down. But at the same time, if we say, well, if we can do something about it, if there would be something that would remove this risk, I could be 7% more competitive, or at least 7% more profitable. Right? No? So this dynamic not only happens in your business, it also happens on your suppliers. This is why when we talked about the suppliers, I was in here, if this supplier that is offering me the United States hotel in euros is buying it in dollars, what is he doing? What he's doing is very clear. He's using the rate that his finance team is giving him to price on the selling side. So he's not taking a 124, he's taking a 120. And he's creating his euro price through an inflated rate. The result of this is that this is the reason why this hotel in euros is more expensive. You are buying from your suppliers with a premium if you're forcing them to buy in the currency you want. If on the other side, you say, I'm going to buy in the currency of my destination, because my supplier is probably buying in the same currency, you will be able to remove this premium. And again, we are back in the start. If you are able to remove this premium, you are able to buy cheaper, and you have two options then. Be more competitive, have a more competitive inventory, sell more, or just decide to go with a higher margin. If you're already competitive with your selling price and you just reduce your cost price, then quite simple, you increase your margin, you make more money. I hope we all agree this is a good thing. Right? I insist, and it's the same case again, but this also happens on the sales side. If you are, let's imagine for a second, we are not the European travel operator, but we are the DMC or the bed bank who is offering this European travel operator the room in the US. The finance director of the European travel operator, let's all remember, is not using the rate of today of 124. He's using the rate of 120. So if I pass him the rate in dollars, just like we saw here, yes, what he is thinking is that we are artificially more expensive. So the relevance of the currency on the selling side is not only for the B2C. It's especially important also in the B2B, because the finance department of our clients are not using the current spot rates. They're using marked up rates, and they are looking at our product as artificially more expensive. Yes, hopefully I didn't lose too much people. I'm repeating the same examples again and again, but the key to this is really the rates your systems, your clients, and your supplier systems are using. If you're able to control this risk, you're able to remove these markups on the buying and on the selling side. And the second part of my presentation today was aimed to describe how we have worked this with a web breakthrough. Okay? So let's go to it. Before Kantox, we have seen the dynamics and the basis theory of what was happening. When we have a look at a single life of a booking, I know there can be many different cases, but let's assume this can be a pretty good example. The pricing was being created with the rate of the day. We were feeding with the ECB rate from yesterday our system with exchange rates, and with that exchange rate we were creating the selling prices, and we were also calculating, our buying machine was calculating from who to buy, based on an exchange rate that is fed daily. Until then, there was the booking moment. We had a client that came and made a booking. Pretty clear. 7 days later, if it's a B2C, we would be receiving the funds. Of course, if it's a B2B, this can be much more delayed. But then the checkout of the client is not going to be until 90 days. We have payment terms to the supplier after 30 days. And the margin consolidation is basically when you are converting the profit that you make. Let's assume we sold in pounds, as the example before, and we are converting it back into a home currency. Let's call it euros. Yeah? Hopefully, it's quite clear this moment on the life of a booking. Let's see what this represents in terms of FX risk. Let's see what we have to take into account in terms of FX risk to make sure we manage it well. Well, there is a gap between the moment we take an FX rate in our system until the moment we have a booking. Normally, all your systems, the custom-made and also the ones you buy off the shelf, go and say, we take the rate from the ECB from yesterday. Well, big piece of news, this rate is fake, is no longer valid. This rate was from yesterday at 4 p.m. And the market moves with a hit of a tweet, and we know who's tweeting. So the movements are not small. If during the day the rate moves significantly, this can create massive pain if the currency we are selling it loses value. Because the moment we are securing a booking, we are already losing money. On the contrary, if we are buying in a foreign currency and this foreign currency loses value, it can create a buying opportunity. We have to understand we can buy cheaper if the currency has depreciated. So we have a risk that is usually limited by changing this rate every day. Yes? Didn't lose too much people yet? Good. Hopefully the non-finance people especially, because this is the part that impacts you the most. This part, this one gap, this daily rate, is what impacts the fact that you sell more or not. Is what impacts that if you buy better or not. So we need to take two things into account here. One is the markup our finance team is putting in this rate, and second is the movement of this rate between the moments the rate is on our system and the new rate when this rate is updated in your systems. Yeah? We all have these 2 points into account? So this is the part where the purchasing people and the sales people should focus the most. But you can only buy in a lot of currencies and sell in a lot of currencies if what I'm going to talk about now is really under control in your companies, which is the main part of the risk for which finance is responsible. When we have a booking, we have committed to sell for £1,000. And we have committed to pay 800 euros to our supplier. So your margin is fixed. And your margin is attached to that rate we were talking about that your system took into account. Then the moment between this booking and the moment until this booking is paid, it is what is going to make the difference. And I brought you here a little example. Imagine we are buying in dollars in this case, and we are selling in euros. And when we made a booking, we took into account a rate of 1.10. No? If we make the calculations, this is a cost of sales of $990. Let's say the cost of sales is 900 euros at this 110, and we sold for 1,000 euros, which would let us to have a 100 euro margin. No? Pretty simple example. Let's see what happens if from this moment of the booking until the moment we need to pay the supplier, the rate moves 4.5%. With an average booking period of 3 or 4 months, it's not crazy to think about this. Actually, the currencies and the euro-dollar, which is not so volatile, I don't want to talk about Thai baht or South African rands, but the currency moves 4.5% against us. It goes from 110 to 105. What happens here is that the moment I have to pay, when I expected to have a cost of sales of 900 euros, it turns out I have to pay 943 euros. Which means that my margin that was going to be 100 euros is now 57 euros. This is a 43% impact in your margin and the commission of the salespeople. And then you will have the internal fight, or is finance who managed it wrong, or is this, or is that, and then the answer is, you know what, we don't do currencies. Or you know what, we're going to use a marked up rate so we don't lose this much. But this is because this risk was not under control. And I'm sorry to say, but it doesn't even end here. Because in this case, imagine we receive the invoice at the checkout moment. So your system, what it's doing is receiving the invoice at the checkout moment. And the accounting is telling us the expected cost of sales is the rate of the day of the checkout. And it's going to compare it at the rate of the payment. So what accounting is capturing as FX risk is much smaller than the real risk, which is this operational risk that we're drawing here. Now it's a lot of concepts, but if you're able to bear with me, here you can really see the problematic this is causing. It's not voluntarily, but all this is very misleading from an accounting, from a finance, and from a selling and buying perspective. So we need to align all of them and find a solution that really gives us clarity on this and really removes this risk. And this is exactly what we worked with the WebBets group. What we basically did was we put a software that feeds into their system an FX rate every day. But it will feed another rate if there is a significant change on the currency. If the currency during the day moves 1%, we will then feed a new rate to tell them, look, you might be buying more competitive now because the rate has moved. We're not changing it because it's Monday or because it's 8 in the morning. We're changing it because the rate has changed. If the rate moves against, of course, we need to sell more expensive because we don't want to sell under margin, right? So this way, the salespeople are always selling with a correct margin. We are not starting the race 3 meters behind. At the same time, if the rate improves for us, we might be more competitive in the market because we are able to react to our price and sell cheaper on that day. But the main part of the solution came then. Once the exposure was materialized, once we know we had a risk, once we know we sold the booking in euros and we have to pay for it in dollars. At this moment, we know what rate did we use to price it, right? Yeah, everyone is with me? And we are going to automatically secure by a forward transaction, which is a very simple financial product, that what basically this is, it guarantees the rate on the day of the booking until the day of the payment. Automatically, for every single booking, for every single currency pair. With this, we are completely removing this operational risk. We can safely sell, because at the moment of the payment, if we expected our margin to be 100 euros, our margin is going to be 100 euros on the moment of the payment. The fear we were talking about before, of including new currencies because it's complex to manage, is suddenly removed. Now we can go to our purchasing teams and say, contract in the local currency of the destination. you need to avoid the markups of your suppliers. Don't buy from this supplier if it's not on the local currency of destination, because if not, their finance team is putting a markup on the rate, and we are buying with a premium. This allowed us that today we are managing more than 150 different currency pairs on WebBet on a fully automated basis. What we are doing so the accounting reflects the same thing is we're basically saying, look, for the invoice that we are going to issue on the checkout moment, we are going to use the same rate we use on the booking moment. If we do so, this accounting risk is going to have the same length as the operational risk. Now suddenly, we have a policy that it goes from top to bottom. The management says, we want to make money on travel. We are not here to speculate on where the FX is going to move. So we want the risk removed. We don't care if the South African is going to appreciate or depreciate. What we care is that the margin our sales guy accomplishes at the moment of the booking is guaranteed when the booking is completed, when the booking is travel. By this, you can securely and safely say to your purchasing people, go and contract in the local currency. And you can go to your client and say, oh, you're a South African client and you're an outbound business? Don't worry, you can buy from me Mallorca in South African rands. Then the dynamics of our client, as we saw before, suddenly is that they are selecting who is giving them less risk, because they don't have the tools to manage it in a proper way. So this game ends up being, even if you're not the most competitive, because there might be a most competitive one, but because he's selling in euros and you're selling in South African rands, your client prefers you. And that is a massive difference. The contracting of these financial products, of course, has a cost. No? Usually in this industry, this cost is absolutely hidden. No? You've experienced this on your credit cards as we talk. You go to the bank, you think they exchange currency without cost, they will say so. But it's not true. What they do is they build their cost inside the rate. What in our case we do, and what we did with the WebBet group, is come transparently and say, we're going to charge this much. And this much is less than any currency markup from any of their clients and any of their suppliers. So it means you don't even have to pay for the service. Because when you are contracting, you can include a markup that equals our cost. So basically, it's absolutely cost neutral. And again, you are gaining in competitiveness, and you are gaining in purchasing efficiency. And that's the whole goal. Currencies are not a problem. Currencies is a great opportunity to really expand your business by buying more efficiently, by selling with less friction, by making it easier for the people that buy from you, that they are not going to support any risk, you'll do it for them. You have it automated. Well, this is the case I wanted to explain you about. I don't want to, just on the conclusions on what we did here. So the currency risk was fully automated. The pricing is now in 27 currencies. And 27 currencies means there's more than 200 pairs of managing exposure. The FX P&L impact after a year of working together was 0.30%. 0.30% in the whole business. And of course, and especially those who know the WebBet groups, they have been in an incredibly expansion path in new countries, in new markets, that we have been able to achieve thanks to having this fully under control. And now, yes, this was the topic I wanted to get your heads around, to really dingle that neuron over there that struggles with currency and say, I want to keep it away, that you're able to go back to your finance teams and say, guys, we need to manage this better, this will make us stronger, and it will. And if you are from the finance team, this also allows you to be not the one who says no, and finally be the why who enables your business, who goes back to the sales team and say, we're going to do that, and you are going to grow more with this. So thank you very much for your attention. Hopefully it was interesting, and especially those who are not for the finance teams finally understood currencies. Thank you very much.
Thank you very much.